Alright everyone, this is a video that has been requested for quite some time now, and I really want to go into exactly what I do to figure out whether or not a stock is a good buy or not. Of course, if you watch our other videos, you'll also notice that we do really go into the specifics of exactly how we calculate the intrinsic value, how we get book value, and then also look at shareholder equity, price to earnings, net income, all that kind of stuff, so we'll get into that in a moment. But essentially, I go into a bit further technicals than what I do in the videos in order to truly decide whether a company is a good long-term buy, because that's something that's really important. Anyway, if you like this video, please do like and subscribe. This is about our channel. It allows us to get this content out to more people so that more people can figure out exactly how to invest in value stocks and how to find good stocks to buy. Anyway, thank you so much for watching, and without further ado, let's get started. Now, I want to start off with the stuff that I like to talk about in my videos, so here's how it goes. Basically, what we do is we look at the intrinsic value of the company. For example, AT&T, that's going to be the stock we're going to use as in this kind of example video. And basically, what I do is I like to look at exactly how it's calculated, make sure that it's accurate, make sure that I agree with exactly how something is calculated, because there's many ways to calculate using an intrinsic value. There are many different intrinsic values, and so you have to understand exactly what you're doing before investing based off of the intrinsic value specifically. So we consider that the projected free cash flow model is something that is very simple, and I've talked about this many videos, but I want to go into specifically how that works here. So of course, I do talk about this in the video, but basically what you do is there's a growth multiple. This is literally all it is. It's just the projected earnings growth per year. So this is based off of like a percentage of the growth per year. This is an estimate entirely, so this is based off of somewhat of speculation, but for our general purposes of investing, this does make sense. And so in general, AT&T is a pretty slow growing company, so the growth multiple is pretty low. Then we multiply that by the free cash flow, and we take a 6-year average of that, and then we add the total stockholders' equity, which is simply the assets minus the debt of the company. Then we multiply that by 0.8 and then divide it by the shares outstanding in the market in order to get the intrinsic value per share of the company. Now, of course, the shareholder equity is really important because it takes into account the assets of the company, because this is where things get to be a little bit more technical. When we're looking into a company, we want to make sure that we take into account earnings, assets, and projected growth for the company. We also want to look at how many shares they have outstanding to make sure that we figure out exactly where the company is valued at based off of that too. Now, how you find this website is actually very easy. What I do is I go to Google, I'll search up AT&T, for example, and I'll look at AT&T stock, for example, and then what I'll do is I will try to find the intrinsic value of the company. So that's literally it. You just put in AT&T stock intrinsic value. It will likely come up first as the projected free cash flow, and there you are. You're at the same site that I was at. And so in general, this is very interesting, and it's not very hard to get to. Now, I like to take a look at Yahoo Finance specifically to figure out the trailing priced earnings and the forward priced earnings, because the trailing priced earnings can be quite a bit higher than the forward priced earnings, because if it's a bad year, for example, we're in a pandemic at the time of recording this, and so therefore the forward priced earnings is a much better way of figuring out exactly what the priced earnings should be for the company. So we consider that for AT&T it's at about 10, versus the trailing priced earnings is at about 20. So there's a noticeable difference. It's very important that we look at forward priced earnings. Forward priced earnings tends to be more accurate, in my opinion, compared to the trailing priced earnings. But of course, the trailing priced earnings has to be not astronomically high. For example, if it's over 100, then that would be a bit concerning to us. However, that is not concerning to us here at this time. Also, Yahoo Finance does a great job at telling you about the book value of the company. So we could see here that you can see exactly what the book value per share of the company is here. AT&T's case is $23 a share. So that's pretty great. You can see that, of course, you want to figure out exactly where the book value is relative to the trading value of the company. So what I like to do is I like to look at the trading value. For example, AT&T is at a trading value of about $30 a share at the time of recording. And so the book value is not very far away from that. That would suggest that the company is likely to be relatively fair valued, if not undervalued, just based off of that alone. Now, of course, AT&T has very strong earnings, and so they're able to back that, of course, with those strong earnings. So that's where the intrinsic value comes into play really well, because the intrinsic value takes into account the earnings and the assets. Since this company has such high asset worth relative to its share price, this will allow the company's intrinsic value to not fluctuate very often. Because the thing is if the book value is really, really low relative to trading value and the earnings are the only thing supporting this intrinsic value, then the problem is this intrinsic value will likely fluctuate if the earnings were to drop for a year. So this would cause a problem for the justification of the price of the stock in the long term. And so since it's hard to predict the market, in my opinion, what I would like to look for is that the company has a really high book value relative to the share price. And then I also like to make sure that the company has at least pretty strong earnings to go along with that. And I will be happy to drop a company and decide not to buy it just because it doesn't have a high book value. Now, I've taken a look at the shareholder equity and the long-term debt and other things like that on our videos, but we consider that, of course, long-term debt is very important. If the company has too much debt, that can be very concerning. So in AT&T's case, a lot of debt. But the shareholder equity, as long as it's pretty high, since the shareholder equity is the assets minus the debt of the company, the long-term debt is kind of irrelevant if the shareholder equity is consistently increasing. I understand that it can hurt the earnings if the company is paying more in debt, but this is actually not too much of a problem as long as the shareholder equity is increasing, because the only thing that the debt can really affect is hurt the asset value of the company, which will lower the justification for the trading value. So this is very important, and I think that as long as the shareholder equity is still increasing, then this will make long-term debt less of a reason to not buy the company. Now, we also take a look at net income. It's very important that you look at this. Make sure that the net income is truly showing a profit, because the net income takes into account the real profitability of the company. It's not revenue, and revenue just tells you exactly how much money the company brings in, but not how much the company is profiting. The net income tells you after paying taxes, after paying any sort of fees, after paying anything, they end up with this specific amount of money at the end of each quarter. And so this is very important, and everyone should be looking at the net income for every company that they own. If the company is not profitable, I would likely just not buy it. I have no reason to risk my money on a company that's not going to be profitable. I understand that it's fun to take a risk and try to figure out if you could predict the future with, maybe a big tech company or something like that. But as a value investor, I like to make sure that I am not investing in an overvalued company. And so I essentially, if the company is not profiting, and the company likely won't have very high asset value either, then the company is likely not going to be a very good value investment and maybe more like a growth investment. So for me, I'm not interested, but others may be. Now, another huge thing that we really like to take a look at as value investors would be price to earnings. Price to earnings is huge because you could take a look at the share price and then take a look at the earnings. And as long as the earnings are trending relatively close to the trading value, then this will allow the price to earnings to probably not be very high. As long as the price to earnings is really below 20, that is generally okay for a company to be trading at. Of course, if a company is trading well above that, maybe they have a price to earnings of 30, then that may suggest that the company is overvalued just based off of that alone. So that is a deterring factor that I definitely like to look at when I am investing in a company. If the company has a price to earnings of 30, like I said, that is likely going to prevent me from buying the company because I'm going to be a bit concerned about that. Now, there is one redeeming factor of this. Basically, if the asset worth of the company is so high that it makes the company worth a lot more than the company's trading value. For example, Kraft Heinz is a prime example of this, where the book value was actually at about $40 a share when the company was trading at about $32 a share. This means that the company's assets make the company worth more than what it's trading for, which is crazy. It's like spending 80 cents or 70 cents for $1. So that would encourage me to purchase the company despite the fact that the earnings wouldn't be too high, because of course Kraft Heinz has good earnings, but the price to earnings can be sometimes pretty high and it can fluctuate quite dramatically. But since the book value is so high relative to the trading value, that allows me to justify buying the company. In fact, I purchased Kraft Heinz at around $32 a share, and now the company trades for around $43 a share. Now, here's something that some people don't always think about. This would be the stock buybacks here. And we consider that for AT&T, the company likes to repurchase its own stock, so that helps to reduce the outstanding shares in the market. Since the book value is the shareholder equity divided by the outstanding shares in the market, this means that if the company repurchases shares of the company, this will help to increase the book value, which helps to justify a higher trading value because it increases the intrinsic value. So this is really important that a company buys back its own stock. You should always make sure that before you invest in a company, you should look at the stock buybacks and figure out if that company is repurchasing its own shares. If the company's outstanding shares are decreasing year over year or relatively steadily, then this means that the company is likely repurchasing its own shares, and this will help you to justify the higher trading value for the company. Of course, you can look at macro trends for that, and the net income, the price to earnings, and the debt to equity, all of that is on macro trends. So what you can do is you can just search up, for example, here, you can look up AT&T net income here, and it will likely come up with macro trends as the first thing. And so you can see here that you click on that, and if you scroll down, you will find exactly what we were looking at in the past. Now, of course, in our videos, we also like to end things off with the dividend history of the company. And of course, if a company is paying a dividend, that is huge for me as an investor that is looking for dividend income and also good value stocks. This is very helpful. I love dividend income. It just gives you profit of the company, and this gives you more cash to reinvest in those shares of the company if they're still undervalued, or buy a different company that's undervalued. So everyone should really have dividend stocks, in my opinion, just because I think it's very important that a company is paying you out in dividends. If a company like Berkshire Hathaway, for example, comes along and says, I'm not going to pay you any dividends because we can reinvest that money back into the company and do better with it, then that's the only reason why I would be okay without getting a dividend. But for the most part, I really like to make sure that the companies I buy are buying back their own stock and paying out dividends. Buying back their own stock is almost an artificial way of building the company's trading value up. This is really helpful, and I think that with the dividend income also from other stocks like AT&T, this helps tremendously. If a company buys back its own stock and it pays a really strong dividend, I'm talking maybe even 5% or above, and that will likely keep more and more investors in the company. Likely this will reduce volatility as well, as a lot of people will like to keep these in maybe retirement portfolios. And so with a higher dividend, those stocks can be less volatile. And so this certainly is the case with AT&T and some other stocks like Verizon and some other telecoms like that. And so I really do find it to be very important that a company pays a good dividend. Now, there's only one more thing I really like to use for investing, and that would be Morningstar. Morningstar is definitely a very helpful program that I've used. And so what they do is they will give you a fair value for the company, but I don't always agree with that. The real reason why Morningstar is so helpful is they will give you exactly what the company does, and they'll give it to you immediately. You don't really have to do too much searching on Google in order to figure out exactly what the company does and how they profit. Morningstar will help you by telling you exactly what they do and figuring out maybe what their thoughts are on it as well. You can look at the bear case, you can look at the bull case, you can do all that kind of stuff. And so Morningstar is definitely helpful with that. And you certainly don't need this service by any means. This just makes it a bit easier because they'll just tell you some information straight up front versus you might have to spend a little bit more time on Google to figure out exactly how this company profits and how it works. So overall, hopefully you found this video helpful. Anyway, thank you so much for watching. If you like this video, please do like and subscribe. It does about our channel, and please comment down below and tell us how you like to invest. Maybe what you find to be important when you're investing in a company, stuff like that. Anyway, thanks again for watching. Now have a good day, everybody.